Good morning, traders and investors. This is Roger Scott, Senior Strategist for Wealth Press. Today is Monday. It's March 20th. We're entering the third week of March. Man, let's see, January, February, March. The first quarter is almost behind us. It's about 7:48 in the morning. The market's going to gear up to open up in a little bit less than 2 hours. Now, we've got a big week ahead of us. I think this week is going to be a big major breaker or a maker for the market, one way or the other. Now, in terms of Fed data, we don't have a lot going on today. We do have over the weekend news, which I'll get to in a minute, between central banks making dollar swaps to boost liquidity, and they're looking at liquidity on a daily basis instead of a weekly basis. I'll talk about that in a minute. Tomorrow, we've got FOMC meeting beginning. Then we've got existing home sales. New home sales and permits looked pretty good last week. Then on Wednesday, Mr. Grim Reaper, Powell, I won't tell you the truth till I'm put in a corner, and then maybe I'll twist it a little bit more. Powell is speaking when he's going to tell us whether rates are going to be going higher, lower, or staying the same. Then you've got jobless claims, new home sales, durable good orders, and the PMI composite. Not a lot of weekly data, not a lot of employment data this week aside from the jobless claims. The biggest focus obviously is going to be on the Fed and what they're going to do. In my humble opinion, I think they're going to raise rates 1/4 basis points, which is priced into the market at this point. Now, looking at the bond market, as you can see here, we're still in a very choppy environment. Although it's pretty wide, it's pretty wide based, but it is still a choppy environment. I would love to see us go up to about the 110 level. I don't think we will unless this bank fiasco brings up more surprises this week, which I don't think it will. I think we're going to start seeing less and less bank news. But that's my opinion, and I can't predict the future. But I'd love to see this go up to about the 110 level and then come down. If you start seeing rates coming down, if you see bonds coming down, which means interest rates are actually getting higher, it's actually a reprieve. Looking at volatility, which we'll look at right now, just to give you an idea of where we stand, it looks like the high was made 13th of last week, about 7 days ago, and we haven't been able to breach that level. So in my humble opinion, I think volatility levels are actually going to cool off this week, and we're going to see more downside in terms of volatility and more directional bias in the stock market. Again, looking at the market right now, we're opening up kind of random, and we were up a few minutes ago. Now we're down. There's not going to be a lot of Fed data today because everybody's gearing up for the FOMC, so markets are going to be a little choppy. Speaking of choppy, notice the Dow right here. It's gotten choppy, and if you look at the Dow over the last several days, it hasn't really been going down very much. It's been kind of choppy in a wait-and-see mode, and the SPY has been doing much of the same. It hasn't really been moving that much against us. It's been just kind of choppy. And again, I mentioned to you guys a few weeks ago that I think markets are going to get choppier because the bond market's getting choppier. And volatility doesn't seem like it wants to go really much higher at this point. So I think things are going to start cooling off unless there's a new route of negative news or a new source of data that we need to deal with for the time being. Now let's talk about global economy and see if we can make heads or tails out of things. So, 3 major U.S. benchmarks closed in the red Friday as ongoing concern about banking sector continues to weigh on market sentiment. Investors are looking ahead to Federal Reserve's upcoming interest rate decision. Now, over the weekend, UBS Bank, they were very busy. Funny, I wanted to open up a bank account at UBS. I actually still do. There's a branch right here. I may go in there next few days. They're a solid bank, and the fact that they're bailing out another bank shows that they're very strong, and they're going to get support from other regulatory sources and possibly other banks. What they're saying is it would buy Credit Suisse Group for 3 billion Swiss francs in a stock-based transaction. Swiss authorities played a crucial role in facilitating the deal as regulators look to shore up the global banking system, which is very important right now. Swiss National Bank pledged to inject over 100 billion Swiss francs of liquidity to support the merger. Wow. That's a lot of cash. They're throwing a lot of money at this. Meanwhile, top central banks, including the U.S. Federal Reserve, European central banks, Bank of Japan on Sunday, pledged to enhance the provisions of liquidity by increasing the frequency of a 7-day dollar swap operation from weekly to daily. That's huge. That means they're going to have complete transparency on a 24-hour basis as opposed to a weekly basis to see the flow of cash coming in and out so they can make decisions much faster. That should give a market a little bit of a boost. That's pretty important. So instead of looking every week, they're going to be doing it on a daily basis. That's actually what banks make dollar swap change to boost liquidity. Very, very important. University of Michigan preliminary data on Friday showed that U.S. consumer sentiment fell for the first time in 4 months. I mean, it's about time. Things are just not that amazing. And we know that rates may be going higher for quite some time. While one-year inflation expectations fell to an almost two-year low of 3.8% for March from 4.1%. That's a great sign. But again, with this banking crisis, I think things are going to be very, very kind of hit or miss or wait and see for the next couple of weeks. Now, here's the stuff that you need to pay attention to this week. That was what happened last week. But now what is going to happen this week? In the coming week, the U.S. Federal Reserve, Mr. Jerome Grim Reaper, I hate this guy. I despise this man. I think this man can't give a straight answer if you put a gun to his head. I mean, seriously, every other Fed has been very clear. This guy, he's been very squirrely. You know what? I got a new name for him. We'll call him Fed Chair Jerome Squarely Powell. His post-policy meetings press conference will be the main highlight. Oh, definitely be the main highlight. So here's the deal. U.S. futures are now looking at a 54% chance of a 0.25 basis point rate increase and a 44% chance of a no hike on Wednesday. Now, I find that to be very hard to believe. I don't think we're going to not have a rate hike. I think we are going to have a rate hike. I mean, Europe had a 0.50 rate hike. I don't see why we would completely dump our odds. I think it's going to go back to 65, 70%. I think we are, in fact, going to have a rate hike. Also this week, we got U.S. existing home sales, something to look forward to because new home sales and permits were off the rocks. Crude oil inventories, that'll be interesting. Building permits, that'll be very interesting. Jobless claims, not so interesting. They've been very, very solid. Let's not make something out of nothing. New home sales, durable goods, core durable goods, that's going to be a very, very important one that Uncle Roger likes to watch. Preliminary numbers. Let's talk a little bit about Europe. Europe stocks are up this morning as participants assessed a historic deal to rescue embattled bank Credit Suisse. That may give what's happening today, what happened over the weekend, may actually cause a little bit of a rally going into the FOMC today because we've been very choppy and very kind of uncertainty. ECB President Christine Lagarde, I like her so much more than Powell. I wish we could change places and put him in Europe and her here. I really like this lady. She was very straight up. If you haven't seen, she did a great 60 Minutes interview about 2 months ago, maybe 6 weeks ago, something like that. Check it out. It was really great, and she was very straightforward. And she did expect rates to go higher. The central bank hopes the Swiss brokered rescue of Credit Suisse will restore calm in the financial markets, and the ECB remains ready to support Eurozone banks with a loan if needed. I mean, everybody's support. The world is really supporting all this. China, let's see what's going on with China. China today closed lower as continuous fear of a global banking crisis overshadowed Beijing's fresh monetary easing policy. How dare they? The People's Bank of Japan unexpectedly cut its reserve requirement ratio by 25 basis points. And the market is still lower. We need China to move. But have you noticed nowhere here it says anything about COVID? Nothing, right? That's the key with China right now. Japan, we're actually seasonally, the EWJ is supposed to go higher today. We actually went long on Friday, and utilities are supposed to go down. That's seasonality. It's not a sure thing. The Japan's Nikkei stock index closed sharply lower and hit a 1-month low as the yen strengthened and the economic outlook darkened amid concerns over the potential banking crisis. Boy, they're taking it one step far, darkened. I mean, things are getting better, not worse. The index's downward momentum was fueled by losses in chemical, petroleum, and plastic, steel, and shipbuilders, not technology. The volatility, which takes into account implied volatility, closed down, not up. So that's really interesting. Stocks to watch today. Cryptocurrency. Cryptos are trading higher as much as most techs are right now because a lot of people are taking money out of banking stocks and putting them back into tech stocks because if banking crisis continues, then rates will not be a big of an issue. And if rates are not as big of an issue, then technology and information stocks will go higher. UBS Group plunged over 8% in pre-market trading. I'm not really too concerned. They're a huge global bank after the bank secured a 3 billion Swiss franc emergency rescue in some battled peer Credit Suisse. And Credit Suisse cratered more than 57% pre-market. I don't think Credit Suisse is going out of business. I think that it's a huge overreaction. First Republic Bank tumbled more than 16%, lowered its lower-term issued rating to B+ from BBB+. BB+, not BBB+. And we have a whole bunch of small cap earnings that are very immaterial today. Looking at momentum levels, which we'll look at right now if my computer starts working. There we go. And you could see here, energy, zero. Zero stocks are trading over 50-day. Look at the 200-day now. Folks, I think energy is going to rally. I really think it's going to rally. Let me show you something here. Just need to switch these charts over. So far, I'm getting a bunch of monkey business. All right. Look at energy on a this is the 200-day moving average. And this is the 200-day moving average going how long? Let's see here. 7 years. Look at where we're at. Look at the bottom. I mean, we just don't go below these levels very much. And if you want to see the 50-day, oy vey, look at this. Look at this thing. I mean, we're at the bottom here. And it's not just energies. It's not just energies. Let me show you something else. Look at financials. I mean, look at where we're at. And in terms of the 200-day, 17%. Let's see. I mean, just really not all that much. We're at the bottom. So this is a good time to start looking to buy, not looking to sell. Look at basic materials. There's a lot of stocks right now, a lot of sectors that are really overdone, really, really good sector. Look at real estate. I mean, real estate, it's insane. And then look at the 200-day on real estate. So I'm very skeptical that this downside route is going to continue. Looking at sectors, individual sectors, let's take a look at them so I can give you a good little preview right now of what to expect. In terms of strength and weakness, you still have technology and communication because interest rates could potentially not go up for a while, but industrial is still there. Notice consumer staples is coming up. Notice healthcare is coming up. I told you that consumer staples and healthcare are going to come up. Utilities is kind of in the still huge gap between consumer discretionary and these two sectors, which is a huge red flag. Energy's at the bottom and financials at the bottom. What I'm anticipating is energy and financial starting to come up and technology, communication, and the consumer discretionary to continue coming down. But the fact that consumer staples and healthcare is coming up is giving a market a nice little boost, which is really, really needed right now. Now, looking at the QQQ, actually, let's look at individual sectors and see how the graph looks. Technology, be really, really careful with technology right now. Let me show you why. Fed is going to be talking this week. Financials, I mean, energy, excuse me, I'm losing my mind, I'm going too fast. Consumer discretionary and technology, I want to show you where they're at. Here we go, technology. See the problem that I'm seeing here. This is the problem. Notice this resistance here. Look at the channel. Now, if it breaks out, it's going to be great, but I think technology is going to come right back down, kind of like it did right here. And I think bonds are actually going to come up a little bit. So it'll be interesting to see what happens. Now, if bonds go up to about 110, I'm selling these suckers. 109.50, 110, I'm going to sell them. But with that said, keep your eye on technology. Technology might start coming down. If technology starts coming down, that means market participants are more likely taking money out of technology, putting them in the bond market, or putting them in these sectors like financial, like healthcare, like utilities possibly. But in terms of individual sectors, real estate looks like it's bottoming out at these levels. Financial looks like it's bottoming out at these levels. Energy looks like it's bottoming out at these levels. Maybe a little bit more, but not much more. Healthcare looks like it's starting to come up a little bit. Look, the lows are getting higher. Consumer discretionary, I would not trust this at all. I'm not trusting technology. I'm not trusting communications, and I'm not trusting consumer discretionary. Basic materials looks like it's bottom. Basically, financials, energy, real estate, industrial, material, they don't look all that bad right now. Notice consumer staples is holding on pretty well. Utilities may come down for a little bit of just a little bit of a dump, or maybe stay around these current levels. But be very cautious with technology and communication services, because if the Fed starts saying there is going to be a rate hike, then you know what that means. These are going to be impacted a lot more than the financial sectors. And also, I believe most of the downside has been priced into the financials. And moreover, I want to show you something else. This is a number of stocks that goes down. I have a number of stocks. This is a breakdown of 20. We've been going 329. Look at this, 377, 500. When you get to that level, they tend to bottom out in the short term. And it looks right now like they've had about as much as they can take. So a lot of these sectors, I think, are going to be coming back at the expense of technology, consumer discretionary, and communication sector. Again, keep your eye on the bond market. And remember, this week is going to be very squirrely because Mr. Jerome Squarely Powell is going to be talking on Wednesday, and we just don't know what he's going to do. Now, folks, we got to be cautious. Don't take big positions. Be really careful. Don't bottom pick financials. This is not a time to be a hero. This is not a time to be a hero. Now, my good friend Chuck Hughes, and he's about to expose one of Wall Street's best kept secrets. It's a new way to potentially get ahead of Wall Street. The way Wall Street invests is changing, absolutely, moving all of the biggest transactions to certain hours of the day. And they've been doing this for a while, and we've been on to them, and we're going to expose them for who they really are today. No monkey business around here. And while they've kept the secret buried for months, even years now, Chuck and I are going to go live today, Monday. Yes, it's urgent, today. Today's March 20th? We're going live Monday at 1 p.m. Eastern Time. That's right. To pull back the curtain and reveal how the rest of us can target these power hour stocks. That's right. Power hour stocks. There's a specific power hour that you need to be aware. And if you've been trading with me for quite some time, you do know what that time is. But we're going to give you some quantifiable data, some information, show you how to trade this the right way, give you some tips and tricks. And Chuck's been doing this for over 35 years. Follow the link for this live event and learn how to target these power hour stocks. Click the link below. If you're watching on YouTube, like this channel, subscribe to us. Don't forget to subscribe to my Telegram channel, Roger Scott Telegram channel. You know why? I'll tell you why. Because I post some bonus seasonality, pattern trades. We do a lot of bonus trades there. If you don't know where the link to the Telegram channel is, it's in the YouTube Wealth Press channel below this video, right below the link for the class that we're going to be holding today live. You can ask us questions, say hello to Chuck, and we'll hang out together at 1 p.m. Eastern Time, Monday, March 20th, today. Bye. I'll see you later. Have a great day. If you have any questions, comments, feedback, don't just sit there. Send me an email, support@marketgeeks.com. Bye, guys. Have a great, great day.